Hey, welcome to the Mortgage Minute. This week in the news, the big news is the Canadian dollar. We got a sinking Canadian dollar going below 90 cents. Now, this is interesting because it puts pressure on the Bank of Canada whether or not to raise rates. You know, the Bank of Canada will raise rates as soon as inflation hits the 2% mark. But the funny thing is, in the last announcement by Stephen Poloz, it's not inflation he's worried about, it's disinflation. Now, typically when the remedy for disinflation is to lower rates. So interestingly enough, the Bank of Canada, for the first time, is at a point where technically they should lower rates to kind of get inflation up a little bit. But as that article says in the Globe and Mail this past week, the Bank of Canada is unlikely to cut rates. So, if they're not going to cut rates, you know they're not going to raise rates. So it looks like status quo on and on again, as it has been for a long time. Meanwhile, in the United States, when we always have to kind of keep an eye on what's happening down there, Ben Bernanke is the America's equivalent of Stephen Poloz. And as you know, Mark Carney left and Stephen Poloz took over. Well, Ben Bernanke is about to leave, and his replacement is going to be a lady named Janet Yellen, is the incoming FAIR chairwoman. Janet Yellen is expected to stay the course and keep policies exactly the same as Ben Bernanke has been. So don't expect to see much change in the United States. Don't expect to see any change in the interest rates in Canada. Having said that, remember, when we talk about the Bank of Canada, we're talking about the short-term variable rates. Long-term fixed rates are governed by the bond yields. The bond yields have had a steady drop. So after the summer surge up into the 3.5% range for the 5-year money, expect it to come down a little softening on the 5-year money. That's my prediction over the next couple of weeks. In the meantime, today's Globe and Mail had a great article on how to make low inflation work for you. Now, this is Rob Carrick talking about perhaps now's the time to take advantage of a low inflation, low interest rate environment to pay down your mortgage, to pay down debt. And I couldn't agree more. I just want to say one thing to all real estate investors out there. If you own real estate as an investment, you know what? There are groups right now promoting the fact that since it's a tax-deductible expense, you should not pay off the mortgage on your rental property. And I just got to say, in my opinion, that is dangerous and irresponsible advice, and I wouldn't listen to it. The reason why? Because we know that in spite of all the talk of a low rate environment, eventually rates do have to rise. And hey, we're not immune to another global collapse. We're not immune to real estate prices coming down. If real estate prices come down and interest rates go up, and you have not taken advantage of lowering your debt in this market, where will you be 5, 10, 15 years from now? Because remember, the reason you're buying real estate as an investment is an alternative to investing in RSPs for your long-term financial health, aside from those who are flipping. So for that end result, make sure that you're taking advantage of the low interest rate and low inflation environment today to pay off debt so that you bulletproof, you recession-proof your portfolio against inevitable rises in rates and potential drops in value. That's the Mortgage Minute for today. You can go to peterkinch.com. And again, welcome questions. If you have anything you want to talk about, send me a question. If you'd like to book a consultation, we're still doing those. And have an absolutely awesome week. Thanks.